Why is Balu Forge suddenly interesting? There are thousands of manufacturing companies in the Indian stock market. Some grow slowly. Some grow rapidly for a few years and then disappear from the spotlight. And some begin changing so quietly that by the time investors notice the change, the business may already be very different from the company they first discovered. Balu Forge belongs to that third category. At first glance, it looks like a manufacturing company making forged components. But that description misses the most interesting part of the story. The company generated more than 1100 crore rupees of revenue in the financial year 2026. Its revenue has grown at roughly 50% annually over the last 3 and 5-year periods. Its profit has grown even faster. Profit has compounded at roughly 88% over 3 years and more than 100% over 5 years. Those numbers alone are impressive. But they're not the reason Balu Forge has suddenly become interesting. The real surprise is hidden inside its future business mix. Defense, aerospace, and railway businesses contributed only about 13% of revenue in financial year 2026. Yet these same businesses represented roughly half of the company's order book. An order book simply means business that has been ordered or contracted and is waiting to be produced and delivered. That difference between what the company earns today and what it has lined up for tomorrow changes the entire way we should look at Balu Forge. Because this is no longer simply a story about selling more of the same products. It is a story about changing what the company makes and who it makes it for. Balu Forge is expanding from traditional automotive and industrial components into defense, aerospace, railways, and increasingly sophisticated precision-engineered products. It has entered the NATO supply chain. It has secured an aerospace order from the United States. It has commissioned a large caliber ammunition shell facility. It has secured an order for artillery shells. And it has entered a 5-year arrangement connected with large caliber ammunition. These developments do not guarantee future profits, but they show that the company is crossing into industries where qualification requirements are much higher and customer relationships can potentially last for many years. At the same time, the company is expanding its manufacturing capacity and investing heavily in advanced forging and precision machining. So 3 different things are happening together. The business is growing, the future order mix is changing, and the manufacturing infrastructure is being built to support that change. That is what makes Balu Forge interesting today. But there is one more piece of evidence that makes the timing particularly important. The company has entered financial year 2027 with a strong first quarter. Revenue increased by almost 29% compared with the same quarter a year earlier. Operating profit also recovered sharply from the previous quarter. The operating margin improved significantly on a sequential basis. Yet profit growth remains slower than revenue growth. And cash generation remains an important weakness. So this is not a story of a company that has already proved everything. It is a story of a company approaching a critical point. The market is beginning to see the possibility of a much larger Balu Forge. But before deciding whether that possibility is real, we need to understand something much more basic. What exactly does Balu Forge manufacture? Because the answer reveals why a company that once looked like another forging manufacturer may be quietly moving into a very different league. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. Before asking where Balu Forge can go next, we need to understand what it actually makes, because the most interesting part of this company is hidden inside a very ordinary sounding word: manufacturing. Balu Forge began its journey around forged crankshafts and forged components. A crankshaft is the heavy rotating component inside an engine that converts the movement of pistons into rotational power. For decades, that business formed the foundation of the company. But describing Balu Forge today as simply a crankshaft manufacturer would be like describing a modern airport as a place where airplanes park. Technically correct, but it misses the entire story. The company today describes itself as a precision engineering and manufacturing company with forging and precision machining capabilities under one roof. Forging means taking a piece of metal and shaping it under enormous force so that the finished component becomes extremely strong. Precision machining comes later. Machines remove and shape the metal with extremely high accuracy so that the final component can meet the exact dimensions required by the customer. That combination is important because the company is not limited to making a basic metal shape. It can increasingly take a component through multiple stages of manufacturing inside its own ecosystem. The process can involve material selection, billet, cutting, forging, heat, treatment, machining, testing, and validation. A billet is simply a prepared piece of metal that becomes the starting material for the forged component. Heat treatment means carefully heating and cooling the metal to achieve the required strength and physical properties. Validation means proving through testing that the finished component performs according to the customer's specifications. And this is where Balu Forge begins to look different. The company has an in-house tool room and metallurgical laboratory, along with research and development capabilities. A tool room is essentially the workshop that creates the dies, fixtures, and specialized tools needed to manufacture components. A metallurgical laboratory studies the properties and behavior of metals. Together, these capabilities allow the company to control much more of the manufacturing process rather than depending entirely on outside suppliers. The company says its product range can cover components from roughly 1 kilogram to much heavier engineered components and lengths extending to several meters depending on the application. And those components are not going into just one type of machine. They can be found across automotive vehicles, agricultural equipment, industrial machinery, earth-moving equipment, oil and gas, marine applications, railways, defense, aerospace, and other engineering industries. That diversification matters because a component manufacturer tied to one customer or one vehicle category can suffer badly when that market enters a downturn. Balu Forge is attempting to build a broader industrial customer base. It already supplies more than 25 OEM customers globally and has an aftermarket and distribution presence across more than 80 countries according to company materials. OEM means original equipment manufacturer. In simple language, it is the company that builds the final vehicle, machine, engine, or industrial product into which Balu Forge's component is installed. And becoming an approved supplier to an OEM is not simply about selling a metal part. The manufacturer has to prove quality, consistency, delivery, reliability, and the ability to produce the same component repeatedly at scale. That is one reason the company has invested so heavily in integrated manufacturing. It is trying to move from being a supplier of individual forged parts toward becoming a more complete engineering partner. And this becomes even more important when we look at where the company is trying to go next. The traditional automotive business remains important, but the company is increasingly targeting areas where components can be more complex and where qualification requirements can be much higher. Defense, aerospace, railways, heavy engineering, advanced industrial applications. The company has already established defense manufacturing capabilities and has described plans covering artillery undercarriage components for armored vehicles, weapons, ammunition, and forged and machined engine components. It has also been developing higher precision capabilities for aerospace and other specialized applications. That changes the economics of the story. A simple forged component can become a highly engineered component. A highly engineered component can become a qualified component. And once a component becomes qualified for a critical application, the customer is not necessarily looking for the cheapest supplier in the market. The customer is looking for consistency, reliability, traceability, quality, and the ability to deliver repeatedly. That creates a potential barrier to entry. A competitor can buy a forging machine, but reproducing decades of manufacturing experience, customer approvals, engineering processes, tooling knowledge, and quality systems is much harder. This is why Balu Forge wants to position itself as a precision engineering company rather than merely a forging company. The difference may sound like corporate language, but financially it can be extremely important. A conventional forging company largely competes on manufacturing capacity, cost, and efficiency. A precision engineering company can compete on technology, complexity, qualification, customer relationships, and the ability to solve difficult manufacturing problems. That is a much more valuable position if the company can successfully achieve it. And there is another detail that makes this transition even more interesting. Balu Forge is not building this capability from scratch. It has been accumulating it for decades. The company traces its foundation to 1989, and its history includes international exports, acquisitions of manufacturing assets from Europe, expansion into precision machining, and development of integrated forging and machining capabilities. So when the company now talks about defense, aerospace, railways, and advanced engineering, the story is not simply about entering unrelated industries. It is about taking an existing manufacturing platform and applying it to more demanding markets. That distinction matters, because the question is no longer whether Balu Forge knows how to manufacture. It clearly does. The real question is whether the markets it is entering are large enough, attractive enough, and structurally favorable enough to transform the economics of the company. And that brings us to the next chapter, because Balu Forge is not making this transition in isolation. The world around it is changing too. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. Is the industry moving in Balu Forge's favor? A company can have excellent factories and talented engineers, but if the industry around it is shrinking, those advantages may not matter. Balu Forge is interesting because the opposite appears to be happening. The industries surrounding the company are becoming more important at exactly the time Balu Forge is trying to move deeper into them. Its traditional foundation is automotive and industrial manufacturing, and even that market is not standing still. India's auto component industry reached roughly 7.6 lakh crore rupees in FY26 after growing about 12.7% during the year. Exports reached around $24 billion. More importantly, the industry has more than doubled in size over the last 5 years. The transformation is not only about producing more vehicles. Indian component manufacturers are increasingly investing in precision machining technology and higher value products while expanding into defense, aerospace, electric vehicles, semiconductors, and other advanced manufacturing opportunities. This matters for Balu Forge because its strategy is moving in exactly the same direction. But the larger opportunity may be outside conventional automotive manufacturing. India is attempting to build greater domestic capability in defense manufacturing. The government continues to push indigenization, which simply means replacing imported defense components with products made within India. In August 2026, the government announced another positive indigenization list covering 405 strategically important defense items with an estimated business potential of about 3,070 crore rupees. The list includes components, subsystem spares, and raw materials for aircraft, armored vehicles, warships, and missile systems. For companies capable of producing complex metal components, this creates a structural opportunity. But there is an even bigger change happening. India is increasingly trying to become part of the global aerospace and defense supply chain rather than serving only its domestic market. That is important because a company supplying a global aerospace or defense customer is competing on more than price. It has to prove quality, consistency, traceability, reliability, and the ability to manufacture the same complex component repeatedly. That creates a much higher barrier to entry. And Balu Forge has already begun moving in this direction. The company says defense, aerospace, and railways now account for approximately half of its order book compared with only about 13% of FY26 revenue. Management has also said these businesses are expected to become a primary revenue driver over the coming years. That is perhaps the clearest evidence that the sector tailwind is aligning with the company's strategy. But there is another tailwind that is less obvious. The global manufacturing map is changing. Large manufacturers increasingly want multiple sources of supply. This is often described as China plus one. The idea is simple. Instead of depending entirely on one manufacturing country, a global company develops another reliable production base. India is trying to become one of those alternative manufacturing locations. For Balu Forge, this matters because it already has experience supplying international customers and has built manufacturing capabilities designed for increasingly complex components. Its first aerospace order from a US customer and entry into the NATO supply chain are therefore more important than the immediate revenue attached to those contracts. They represent external validation of the company's ability to meet demanding manufacturing standards. And the opportunity extends beyond defense and aerospace. Railways are another important growth area. Heavy engineering remains relevant. Oil and gas continues to require specialized components. Power generation creates demand for large engineered parts. Agriculture provides another cyclical demand source. And commercial vehicles remain an important part of the existing business. This diversification gives Balu Forge several different sources of potential demand. But this is where the story becomes more interesting. Because every powerful industry tailwind creates a corresponding danger. The defense industry can have enormous order books But government procurement can take time. Aerospace can offer attractive long-term programs, but qualification can take years. Manufacturing demand can rise while factories struggle to execute because skilled capacity and supply chains become bottlenecks. PwC recently highlighted precisely this issue in India's aerospace and defense industry. The sector is entering a high-growth phase, but execution capacity could become the biggest constraint, with large order backlogs potentially taking years to clear. That warning is particularly relevant for Balu Forge, because the company is not merely waiting for demand. It is building capacity ahead of that demand. The opportunity therefore has two sides. If Balu Forge can convert its order book into production efficiently, the sector expansion can become a powerful earnings engine. But if demand arrives faster than the company can execute, the same opportunity can create delays, working capital pressure, and lower returns on the capital already invested. There is another important shift happening inside the auto component industry. The future is increasingly moving toward precision rather than simply volume. Goldman Sachs expects India's auto component industry to grow at roughly 10% annually between FY26 and FY30, with precision machining and diversification into areas such as defense, aerospace, electric vehicles, and other advanced industries supporting that expansion. That is exactly the direction Balu Forge is trying to take. So the sector is not merely giving the company more customers. It is potentially rewarding the type of capabilities the company has been investing in. And that distinction matters. A rising industry can lift almost every company. But a structural change in the industry can disproportionately benefit companies that already possess the technology capacity and customer relationships needed for the next stage. Balu Forge appears to be positioning itself for that second kind of opportunity. Yet there is one question still unanswered. A favorable industry can create opportunity, but only a company with the right capabilities can capture it. And Balu Forge has spent years collecting capabilities that now begin to look surprisingly relevant. The next question is therefore not about the sector. It is about the company's own sequence of breakthroughs. Because sometimes the most important clues about where a company is going are hidden in the things it has already done for the first time. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. The power of first. The most valuable milestones in a company are not always the biggest orders. Sometimes the real breakthrough happens when a company does something for the first time, because the first achievement changes what becomes possible afterwards. Balu Forge has a history that makes this idea particularly important. The company was founded in 1989, and its early journey was built around forging and engineering components. Then came a seemingly simple but important milestone. Its first component was exported to an overseas market. That first export mattered because it changed the company from a manufacturer serving its immediate market into a company capable of proving its products outside India. Over time, that international footprint expanded dramatically. The company says it eventually built a presence across more than 80 countries and developed relationships with 25 global original equipment manufacturers. But the more important transformation happened when Balu Forge began acquiring and integrating advanced manufacturing capabilities. It acquired the Ursus manufacturing plant in Poland and later acquired the ThyssenKrupp facility in France. These were not simply additions to the factory map. They brought manufacturing knowledge, equipment processes, and capabilities that helped the company move toward more sophisticated engineering products. Then came another important first. The company developed the ability to produce and machine increasingly complex components within an integrated manufacturing environment. Integrated manufacturing means controlling several stages of production within the same business rather than depending on multiple outside suppliers. That capability became increasingly valuable as customers demanded tighter tolerances, more complex shapes, and greater consistency. Then came a much bigger first. Balu Forge entered the defense manufacturing ecosystem. The company established a specialized manufacturing unit for defense products and later became an approved vendor to the Ordnance Factory Board. That was the beginning of a completely different opportunity. Defense manufacturing requires precision, but it also requires reliability, traceability, consistency, and the ability to meet strict specifications repeatedly. The company then moved another step forward. It built a fully automated empty shell forging and machining line with an annual capacity of approximately 360,000 shells. The line was developed at the company's Greenfield manufacturing campus in Belgaum. Greenfield simply means a new facility built from the ground up rather than an expansion of an existing factory. This was no longer simply about making conventional forged components. It was about creating a dedicated platform for a strategic defense product. Then came another first. Balu Forge entered the NATO supply chain for critical defense components. NATO is a military alliance whose members and associated supply networks operate under demanding standards for defense equipment and components. For Balu Forge, the importance of this milestone was not merely the immediate business opportunity. It was external validation. The company was demonstrating that its manufacturing capabilities could meet the requirements of an international defense supply chain. Then came another step that made the defense opportunity more tangible. In February 2026, the company entered into a 5-year agreement for the supply of large-caliber ammunition from its Belgaum facility. The agreement covered multiple shell variants and was structured to begin supplies in phases. The company said the contracted volumes were larger than its existing annual capacity, and that it planned to expand production using internal accruals. This is an important detail. The company was no longer simply building a capability and waiting for customers. Demand was beginning to influence the next phase of capacity expansion. And then came perhaps the most important first of all, aerospace. In May 2026, Balu Forge received its first commercial aerospace purchase order from Alpha Aircraft Systems in the United States. The company received the advance payment and tooling payment and began the development and manufacturing phase. Aerospace is a completely different level of manufacturing discipline. Components can involve complex metallurgy and extremely tight manufacturing tolerances. A tolerance is simply the tiny amount by which a component is allowed to differ from its exact specified measurement. In an aircraft application, that difference can matter enormously. The first aerospace order, therefore, represents more than another customer. It is evidence that capabilities developed over many years are beginning to qualify the company for a new category of work. And the sequence continued. In June 2026, Balu Forge secured an initial order for 30,000 152mm artillery shells from an Indian defense player. The company said the order could potentially scale to more than 100,000 shells with additional variants. The production is being driven by its automated shell manufacturing line in Belgaum. Then in August came another striking development. The company successfully commercialized the 155mm extended range full-bore ammunition variants and received the first purchase order for this product. The pilot supply is for 10,000 units before regular monthly supplies begin under mutually agreed quantities. This matters because the company is moving further into technically demanding defense products rather than remaining only a supplier of basic forged components. Look at the sequence. First export, then global customers, then advanced manufacturing, then defense, then automated ammunition manufacturing, then NATO supply chain entry, then a 5-year ammunition agreement, then the first aerospace order, then the first advanced artillery shell commercialization. These milestones are connected. Each one increases the range of businesses the company can realistically pursue. But there is an important distinction investors must understand. A first achievement is not the same as a mature revenue stream. An aerospace order does not immediately make aerospace a large business. A defense agreement does not automatically mean all potential volumes will appear in 1 year. An approval does not guarantee unlimited future orders. And an order does not become cash until the company manufactures it, delivers it, and collects the money. So the real power of these firsts is not the immediate revenue. It is that they expand the company's possible future. A company that could previously compete for conventional automotive components can now compete for defense components. A company that could compete for defense components can now pursue ammunition programs. A company that has entered ammunition can pursue more sophisticated variants. A company that has entered aerospace can attempt to qualify for additional aerospace programs. And a company that has proven itself in one demanding global supply chain can use that credibility when approaching another. This is why the sequence of milestones is more interesting than any single announcement. Balu Forge is gradually increasing the number of doors it can knock on. But there is one problem. Opening doors does not create wealth. The company now has to walk through them. It has to manufacture at scale. It has to deliver consistently. It has to earn acceptable margins. And eventually those new capabilities have to appear in the quarterly numbers. That is why the next milestone in the story is not another acquisition or another announcement. It is the first quarter of the new financial year. Because the real question is whether all these firsts have finally started appearing in the financial performance. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. And that is where the next chapter begins. Sometimes the beginning of a financial year tells you more than the final number at the end of the year, because the first few months reveal whether the investments made yesterday are beginning to change the business today. Balu Forge entered FY27 with something investors had been waiting to see. Evidence that the expansion story was beginning to appear in the numbers. The company generated revenue of about 301 crore rupees from operations. That was almost 29% higher than the same period a year earlier. Total income was about 305 crore rupees, which was nearly 30% higher than the previous year. But the more interesting number was what happened compared with the immediately preceding period. Revenue increased about 14%. Operating profit increased more than 41%. And the operating margin recovered from about 23% to more than 28%. Operating margin simply means how much operating profit remains from every 100 rupees of revenue after the main operating expenses are paid. That sequential recovery is important. It suggests that the weakness seen previously was not necessarily the beginning of a structural deterioration. The company was able to regain operating momentum. But this is where the story becomes more complicated. Because revenue grew much faster than profit. Operating profit increased about 17% compared with the same period a year earlier. Profit after tax increased about 16%. Earnings per share increased only about 9%. Earnings per share means the amount of profit attributable to each individual share. So the numbers tell two stories at once. The first story is encouraging. Balu Forge is growing. It is growing at a healthy rate. Its operating performance has recovered strongly from the previous period. And the business is entering FY27 with considerably stronger revenue momentum. But the second story tells us why investors should not become complacent. The growth in revenue has not yet translated into an equally powerful increase in profit per share. That difference matters. Because eventually the market will care less about how many products Balu Forge sells and more about how much economic value those products create. There is another fascinating development hidden inside the numbers. The company's defense, aerospace, and railway contribution has risen sharply. These businesses had represented only around 13% of FY26 revenue. But their contribution has moved to roughly one-third of revenue in the latest period, while they still represent approximately half of the order book according to recent analysis of the company disclosures. That is a remarkable change in a very short period. It means the transformation discussed earlier is no longer only visible in presentations and announcements. It is beginning to appear in the revenue mix. And that is perhaps the most important power of this first period. The business is starting to look different inside the financial numbers. But the market also needs to understand why profit did not grow as quickly as revenue. Raw material costs increased faster than revenue. Finance costs rose significantly. Depreciation also increased as the company carried a larger manufacturing asset base. Depreciation is an accounting charge that spreads the cost of a factory or machine over the years in which that asset is expected to be used. Higher depreciation is therefore partly the consequence of expansion. But it still matters because those new assets must eventually generate enough additional profit to justify the capital invested in them. Finance costs are even more important. The company is moving through an expansion phase and financing costs have risen substantially compared with the previous year. That means the new manufacturing capacity is already creating costs before the full economic benefit of that capacity has necessarily appeared in profit. This is the central tension inside the numbers. The company is investing for tomorrow, but investors are paying for the possibility of tomorrow today. The expansion therefore has to deliver. And there are early signs that it may be starting to do so. Revenue is accelerating. Operating profit has recovered strongly. The contribution from strategic businesses is increasing. New defense capabilities are moving into production. Aerospace activity is beginning, and the company is building capacity for a much larger manufacturing footprint. Yet one number remains stubbornly important: cash. Profit is an accounting measure. Cash is what ultimately arrives in the bank. A rapidly growing manufacturer can report strong profits while cash remains tied up in inventory and customer receivables. That is why the next stage of Balu Forge's journey cannot be judged only by revenue growth. The company now needs to prove that its growing business can generate increasingly strong cash flows. And there is another reason this first period matters. It gives investors the first real baseline against which the rest of FY27 can be measured. If the next few periods show revenue continuing to grow at a healthy pace, if operating margins remain around the high 20s or improve, if defense, aerospace, and railway revenue continues increasing, if new capacity becomes more productive, and if operating cash flow begins catching up with profit, then these early numbers could eventually look like the beginning of a much larger earnings cycle. But if revenue continues rising while margins weaken and cash remains trapped inside working capital, then the market may begin to question whether the growth is creating enough shareholder value. That is why this beginning is powerful. It does not prove the entire story. It gives us the first serious evidence with which to test the story. And now the most fascinating question is waiting. If the company is already showing stronger revenue momentum, and if strategic businesses are becoming a much larger part of what it sells, what exactly is waiting behind that growth? Because the order book contains a clue. The company has built a future business that is beginning to look very different from the business that produced its historical revenue. And that is where the next chapter takes us. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. Marketing punchline. A company can show rising sales and rising profits on paper, but the real test of its growth begins when those profits have to find their way into the bank account. Balu Forge has one of the most impressive profit growth records in its peer group. Over the last 5 years, profit has grown at more than 100% annually. Over 3 years, the growth rate has been close to 88%. The company has also built operating margins of around 27%. Operating margin simply means how much money the company keeps from its sales after paying the main costs of running the manufacturing business. On the surface, this looks exceptionally strong. But an investor has to look one level deeper, because profit and cash are not the same thing. When Balu Forge sells a component to a customer, it can record the sale as revenue and eventually recognize the associated profit. But the customer may not pay immediately. Until the money arrives, that amount sits as a receivable. A receivable simply means money that customers owe the company. And this is where the Balu Forge story becomes much more interesting. The company has grown rapidly. Rapid growth requires more raw materials, more inventory, more production, more customer credit, and more money tied up between manufacturing a component and collecting payment for it. That money is working capital. Working capital is essentially the cash temporarily trapped inside the operating cycle of the business. The company buys material. It manufactures the component. It delivers the product. The customer takes time to pay. Only then does the cash return to Balu Forge. If the business grows very quickly, the amount of money trapped in this cycle can also increase rapidly. And Balu Forge has experienced exactly this tension. Its working capital requirement remains high. Debtor days are around 140 days. Debtor days simply measure roughly how long the company takes to collect money from customers. Inventory days are around 75 days. That means cash can remain tied up in stock before it becomes a sale, and then remain tied up again while the customer takes time to pay. The result is visible in the cash flow statement. Balu Forge generated operating cash flow of only about 32 crore rupees in FY26. Operating cash flow means the cash generated from the company's normal business operations after accounting for the movement in working capital. Compare that with profit after tax of around 259 crore rupees. The difference is enormous. This does not automatically mean the reported profit is false or low quality. That would be an unjustified conclusion. The company has been investing heavily in expansion. Its fixed assets increased dramatically. Capital work in progress has also been substantial. Capital work in progress means money already spent on factories, equipment, and projects that are not yet fully operational. So part of the cash pressure comes from a company deliberately building capacity for future growth. But that explanation cannot be used forever. Eventually, the new capacity must generate enough operating cash to compensate for the capital being invested. And that is the real test for Balu Forge. The company does not need to produce perfect free cash flow while it is aggressively expanding. But investors should expect the direction to change as new facilities become productive, as utilization rises, as production scales, as customers pay. Operating cash flow should begin moving closer to reported profit. That would be a powerful confirmation that the expansion is creating genuine economic value. There is another number worth watching. Free cash flow has remained negative during the heavy investment phase. Free cash flow means the cash left after the company has paid for the capital expenditure required to maintain and expand the business. Negative free cash flow is not necessarily alarming for a company building new factories. A company investing heavily today can deliberately sacrifice current free cash flow in exchange for greater future earning capacity. The danger appears when the investment keeps increasing, but the expected earnings and cash generation never arrive. That is why Balu Forge now enters an important phase. The company has already spent significant amounts building capacity. It has expanded its manufacturing footprint. It has developed defense capabilities. It has invested in precision machining. It is entering aerospace. It is increasing production capability. Now the assets need to start working harder. The next stage should ideally produce a different financial pattern. Revenue should continue growing. Profit should continue growing. But more importantly, operating cash flow should begin catching up. Working capital should become more efficient. Receivable days should stabilize or decline. And free cash flow should eventually move toward positive territory. If that happens, something important changes in the way investors can value the company. The business would no longer be viewed simply as a rapidly expanding manufacturer that needs large amounts of capital to support growth. It could increasingly be viewed as a business capable of funding part of its own expansion through internally generated cash. That is a much stronger position. It also improves the quality of the valuation. Because discounted cash flow valuation ultimately depends on cash, not accounting profit. Discounted cash flow means estimating the future cash a company can generate and converting those future amounts into today's value. If Balu Forge's cash generation improves alongside earnings, the valuation becomes easier to defend. If profits continue rising but cash remains weak, investors have to apply greater caution. This is why cash flow is not a side issue in the Balu Forge story. It is the bridge between the company's expansion story and its valuation story. The company has already demonstrated that it can grow revenue. It has demonstrated that it can grow profit. It is demonstrating that it can enter new markets. Now it has to demonstrate that all of those achievements can ultimately produce cash. And there's another important connection. Management is asking investors to believe that the company can become significantly larger through defense, aerospace, railways, precision machining, and higher value products. That ambition requires capital. Factories require capital. Machines require capital. Inventory requires capital. Customer growth requires working capital. The most interesting number in Balu Forge may not be the revenue it has already earned, but the business waiting to be manufactured. To understand why the future could look very different from the past, we need to look at the order book. An order book is simply the value and volume of business that has already been ordered or committed and is waiting to be produced and delivered. And Balu Forge has a striking difference between what it earns today and what customers are asking it to make tomorrow. Defense, aerospace, and railways accounted for only about 13% of the company's revenue in FY26. But these same businesses represented roughly 50% of the order book. That gap is one of the most important facts in the entire Balu Forge story, because it suggests that the revenue mix investors see today may significantly understate the business mix that could emerge over the next few years. Think about what that means. If a company receives most of its future orders from the same products that generated its historical revenue, then the future can be estimated largely by extending the past. But when the order book is increasingly concentrated in newer businesses, the future becomes a different calculation. Balu Forge is building a pipeline where defense, aerospace, and railway work can become much more important contributors to revenue. And these are not markets that appeared overnight. The company has been investing in the capabilities required to participate in them. Its defense operations include large caliber ammunition capabilities. Its automated empty shell manufacturing line has an annual capacity of approximately 360,000 shells. It has secured defense orders and entered longer duration arrangements. Its aerospace business has received its first commercial order from a US customer, and the company has entered the NATO supply chain. NATO is a military alliance whose supply chain requires manufacturers to meet demanding standards for defense equipment and components. Each of these developments expands the potential pool of future business. But there is a very important distinction between potential revenue and actual revenue. An order book is not the same thing as sales. A memorandum of understanding is not the same thing as a purchase order. A purchase order is not the same thing as a shipment. And shipment is not the same thing as cash collected. That sequence is extremely important for Balu Forge because the company is now operating at a scale where execution can become as important as demand. The opportunity is large, but the company has to manufacture what customers have ordered. That is why capacity expansion becomes central to the order book story. Balu Forge is targeting forging capacity of approximately 150,000 tons annually and machining capacity of more than 80,000 tons annually. Machining means precisely shaping the forged metal into the exact component required by the customer. The company is therefore building a manufacturing platform capable of handling much larger volumes of increasingly sophisticated components. And this is where the order book becomes more than a list of future contracts. It becomes a test of whether the company has built the right capacity at the right time. If the demand materializes and the factories reach healthy utilization, the same infrastructure can support substantial revenue growth without requiring the company to recreate its manufacturing base from scratch. But if customer programs are delayed or qualification takes longer than expected, the company could find itself carrying significant capacity before the corresponding revenue arrives. That is the first major risk hidden inside a strong order book. The second is product mix. Not every rupee of revenue has the same economic value. A basic forged component and a highly engineered aerospace or defense component may require very different levels of technology qualification and customer involvement. Balu Forge is deliberately trying to increase the proportion of fully machined and value-added products. Value-added simply means the company performs more sophisticated processing before selling the final product and therefore captures more economic value from the same basic material. This strategy could increase revenue per unit and potentially support healthier margins. But once again, the proof will come through execution. The company has to show that these newer products can be produced consistently and profitably at scale. There is also an interesting geographical dimension. Balu Forge already has a global customer base and a presence across more than 80 countries. That gives the company access to multiple markets rather than making it dependent entirely on domestic demand. But global customers also bring higher expectations. Delivery schedules become critical. Quality standards become stricter. Currency movements can affect reported results. And international trade policy can change unexpectedly. So the order book creates opportunity, but also raises the standard of execution. Now consider what happens if everything works. The existing automotive and industrial businesses continue growing. New defense orders begin contributing more consistently. Aerospace programs move beyond initial qualification. Railway business expands. Machining capacity rises. New customers are added. And the company gradually moves toward a greater proportion of higher value engineered products. In that scenario, Balu Forge does not simply become a larger version of its current business. Its revenue composition itself changes. That is potentially much more important than simple revenue growth. Because a company can grow by selling more of the same product, or it can grow by moving into businesses with larger opportunities and stronger barriers to entry. Balu Forge is attempting the second route, and the early evidence is already visible. The strategic sectors that once represented a small part of current revenue are becoming a much larger part of the order pipeline. That is why the order book deserves so much attention. It gives investors a glimpse of where management believes future demand is coming from. But it also creates a responsibility. The company has to convert that future demand into productive assets, then into shipments, then into revenue, then into profit, and finally into cash. The next question is therefore critical. Balu Forge has been building factories and expanding capabilities in anticipation of this opportunity. But how efficiently can those new factories actually be used? Because a large factory can create enormous operating leverage when it is full, and become a heavy burden when it is not. That brings us to the next chapter. The factory before the fortune. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. Chapter 07. The factory before the fortune. Marketing punchline. A company cannot turn a large order book into a large business unless it has the physical ability to manufacture what customers are asking for. And this is where Balu Forge has made one of its biggest bets. The company is not waiting for its future to arrive before preparing for it. It has been building the manufacturing infrastructure in advance. Today, the company has a forging capacity of around 100,000 tons a year and machining capacity of around 45,000 tons. The plan is to take forging capacity toward approximately 150,000 tons and machining capacity toward more than 80,000 tons a year. That is a substantial expansion. But capacity by itself does not create revenue. Capacity utilization is the important concept here. It simply means how much of the available factory capacity is actually being used. A factory capable of producing 100 units but producing only 50 is operating at 50% utilization. This matters because the economics of manufacturing can change dramatically as utilization rises. Many of the costs associated with a factory exist whether production is high or low. Buildings have to be maintained. Machines have to be depreciated. Engineers and operators have to be employed. Utilities and maintenance have to be paid. Once these costs are already in place, additional production can potentially add revenue faster than it adds fixed costs. This is called operating leverage. Operating leverage simply means that when production increases within an existing manufacturing structure, a larger portion of the additional revenue can flow toward operating profit because some major costs are already covered. This is one reason Balu Forge could become significantly more profitable if its new capacity is absorbed by demand. But there's another side to the equation. If the company builds capacity faster than customers use it, operating leverage works in reverse. The company has invested the money. The machines are sitting inside the factory. Depreciation is being charged. Interest and other financing costs may be incurred. But the revenue required to absorb those costs has not arrived at the same speed. That is why capacity expansion is simultaneously one of Balu Forge's biggest opportunities and one of its biggest execution risks. And the timing of this expansion is particularly interesting. The company is increasing capacity at the same time that the composition of its order book is changing. Defense, aerospace, and railway businesses represent a much larger share of the order pipeline than they do of current revenue. So management is effectively making a bet that this future demand will become sufficiently large and sufficiently durable to justify the additional manufacturing infrastructure. The Hatargi facility is central to this strategy. The company has developed a large integrated manufacturing platform. They're combining forging and machining capabilities. Integrated manufacturing means several important stages of production can be handled within the same manufacturing ecosystem. That can give the company greater control over quality, delivery schedules, and production efficiency. It can also allow Balu Forge to offer customers more than a basic forged component. The company can increasingly move toward finished and fully machined components. That matters because value is not created only by producing more metal. It is created by solving a more difficult manufacturing problem. A forged piece of metal may be relatively simple. A finished component that has been forged, heat, treated, machined, inspected, and qualified for a demanding defense, aerospace, or industrial application is a completely different product. The more stages Balu Forge can perform successfully, the greater the potential value captured from each component. And this is why the company is investing in advanced machining capabilities. It has 7-axis and 11-axis machining capabilities. Axis in machining refers to the directions in which a machine can move its cutting tools or workpiece. More axes allow manufacturers to create complicated shapes with greater precision and fewer separate setups. that can be particularly useful for complex engineered components. The company has also installed large forging equipment, including a 25-ton hydraulic hammer. A hydraulic hammer uses enormous control force to shape metal into the required form. These are not small investments. They represent a long-term commitment to a much larger manufacturing footprint. And that brings us to an important question about capital efficiency. Return on capital employed measures how effectively a company turns the money invested in its operations into operating profit. Balu Forge has historically produced healthy returns on capital. But the expansion temporarily creates a challenge. Capital gets invested before the full earnings benefit arrives. So return on capital can fall during the investment period even when management is doing the right thing. The real test comes later. As the new assets become productive, returns should begin moving upward again. That is the moment investors should watch closely. If revenue grows while utilization rises and margins remain healthy, the expansion begins to justify itself. If revenue grows but utilization remains weak, the company may have expanded ahead of demand. And there is one more factor that makes this particularly important. Balu Forge is not only increasing the size of its factories, it is increasing the complexity of what those factories are expected to produce. Defense components, large caliber ammunition, aerospace components, railway components, precision engineered products. These products can require longer qualification cycles and more demanding production standards. So the challenge is not simply filling machines with orders. The company must make the right products for the right customers, at the right quality, at the right cost, and at sufficient scale. That is why the capacity story cannot be separated from the order book story. The order book tells us what customers may want. Capacity tells us whether Balu Forge can physically respond. Utilization tells us whether that capacity is actually being used. And margins tell us whether the company is making enough money from using it. But there is one final test that brings all four together. Even if the factories are busy, even if revenue rises, even if profits rise, the expansion is not fully successful until those profits begin turning into cash. Because the factory can produce components, the income statement can produce profits. But only cash can ultimately fund the next stage of growth without constantly demanding new capital. And that is where the Balu Forge story becomes much more interesting. Because behind the impressive and profit numbers sits a question that every serious investor eventually has to ask. How much of that reported profit is actually reaching the company's bank account? Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. And that takes us to the next chapter. The profit that has to become cash. A company can show rising sales and rising profits on paper, but the real test of its growth begins when those profits have to find their way into the bank account. Balu Forge has one of the most impressive profit growth records in its peer group. Over the last 5 years, profit has grown at more than 100% annually. Over 3 years, the growth rate has been close to 88%. The company has also built operating margins of around 27%. Operating margin simply means how much money the company keeps from its sales after paying the main costs of running the manufacturing business. On the surface, this looks exceptionally strong. But an investor has to look one level deeper, because profit and cash are not the same thing. When Balu Forge sells a component to a customer, it can record the sale as revenue and eventually recognize the associated profit. But the customer may not pay immediately. Until the money arrives, that amount sits as a receivable. A receivable simply means money that customers owe the company. And this is where the Balu Forge story becomes much more interesting. The company has grown rapidly. Rapid growth requires more raw materials, more inventory, more production, more customer credit, and more money tied up between manufacturing a component and collecting payment for it. That money is working capital. Working capital is essentially the cash temporarily trapped inside the operating cycle of the business. The company buys material. It manufactures the component. It delivers the product. The customer takes time to pay. Only then does the cash return to Balu Forge. If the business grows very quickly, the amount of money trapped in this cycle can also increase rapidly. And Balu Forge has experienced exactly this tension. Its working capital requirement remains high. Debtor days are around 140 days. Debtor days simply measure roughly how long the company takes to collect money from customers. Inventory days are around 75 days. That means cash can remain tied up in stock before it becomes a sale, and then remain tied up again while the customer takes time to pay. The result is visible in the cash flow statement. Balu Forge generated operating cash flow of only about 32 crore rupees in FY26. Operating cash flow means the cash generated from the company's normal business operations after accounting for the movement in working capital. Compare that with profit after tax of around 259 crore rupees. The difference is enormous. This does not automatically mean the reported profit is false or low quality. That would be an unjustified conclusion. The company has been investing heavily in expansion. Its fixed assets increased dramatically. Capital work in progress has also been substantial. Capital work in progress means money already spent on factories' equipment and projects that are not yet fully operational. So part of the cash pressure comes from a company deliberately building capacity for future growth. But that explanation cannot be used forever. Eventually, the new capacity must generate enough operating cash to compensate for the capital being invested. And that is the real test for Balu Forge. The company does not need to produce perfect free cash flow while it is aggressively expanding. But investors should expect the direction to change as new facilities become productive, as utilization rises, as production scales, as customers pay. Operating cash flow should begin moving closer to reported profit. That would be a powerful confirmation that the expansion is creating genuine economic value. There is another number worth watching. Free cash flow has remained negative during the heavy investment phase. Free cash flow means the cash left after the company has paid for the capital expenditure required to maintain and expand the business. Negative free cash flow is not necessarily alarming for a company building new factories. A company investing heavily today can deliberately sacrifice current free cash flow in exchange for greater future earning capacity. The danger appears when the investment keeps increasing, but the expected earnings and cash generation never arrive. That is why Balu Forge now enters an important phase. The company has already spent significant amounts building capacity. It has expanded its manufacturing footprint. It has developed defense capabilities. It has invested in precision machining. It is entering aerospace. It is increasing production capability. Now the assets need to start working harder. The next stage should ideally produce a different financial pattern. Revenue should continue growing. Profit should continue growing. But more importantly, operating cash flow should begin catching up. Working capital should become more efficient. Receivable days should stabilize or decline. And free cash flow should eventually move toward positive territory. If that happens, something important changes in the way investors can value the company. The business would no longer be viewed simply as a rapidly expanding manufacturer that needs large amounts of capital to support growth. It could increasingly be viewed as a business capable of funding part of its own expansion through internally generated cash. That is a much stronger position. It also improves the quality of the valuation. Because discounted cash flow valuation ultimately depends on cash, not accounting profit. Discounted cash flow means estimating the future cash a company can generate and converting those future amounts into today's value. If Balu Forge's cash generation improves alongside earnings, the valuation becomes easier to defend. If profits continue rising but cash remains weak, investors have to apply greater caution. This is why cash flow is not a side issue in the Balu Forge story. It is the bridge between the company's expansion story and its valuation story. The company has already demonstrated that it can grow revenue. It has demonstrated that it can grow profit. It is demonstrating that it can enter new markets. Now it has to demonstrate that all of those achievements can ultimately produce cash. And there's another important connection. Management is asking investors to believe that the company can become significantly larger through defense, aerospace, railways, precision machining, and higher value products. That ambition requires capital. Factories require capital. Machines require capital. Inventory requires capital. Customer growth requires working capital. So the better the company's cash generation becomes, the less dependent its future becomes on continuously raising additional money. That is why the next phase of Balu Forge is not just about growth. It is about the quality of growth. And that brings us to the people making the decisions behind this expansion. Because when a company is investing heavily before the full returns arrive, management's promises become particularly important. Investors need to know what management believes is coming next, what capacities it expects to build, which businesses it expects to scale, and how confidently it can turn those plans into financial results. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. The next chapter therefore moves away from what the numbers have already shown us and toward what management believes those numbers can become. The Management Bet. Chapter 09. What exactly is management promising? Marketing punchline. When a company is spending heavily today for growth, tomorrow the most important question is not what management says it wants to achieve, but what has to happen for those promises to become numbers. Balu Forge management is not presenting the company as a traditional automotive component manufacturer anymore. The strategy is much broader. The company wants the non-automotive part of the business to become increasingly important in the years ahead. That means defense, aerospace, and railways are expected to take a larger share of revenue, while the existing commercial vehicle and other industrial businesses continue to grow even though their proportion of the overall business may decline. That is the first major promise. The company is effectively telling investors that future growth will come not only from doing more of what it already does, but from changing the composition of what it does. And management is backing that ambition with physical capacity. The company currently has forging capacity of around 100,000 tons per year and plans to expand it in phases toward 150,000 tons. Machining capacity of around 45,000 tons is planned to increase toward 80,000 tons. Capacity means the maximum amount the manufacturing system can potentially produce. But the promise hidden inside this expansion is much bigger than the numbers suggest. Management is effectively betting that demand will be strong enough to keep these additional machines increasingly busy. Because an empty factory is an expense, a productive factory can become an earnings engine. And Balu Forge is making that bet particularly heavily in areas where it believes the future opportunity is strongest. Defense, aerospace, railways, high-precision machining, and complex engineered components. Management says it is expanding its customer base in these industries and developing capabilities specifically for their requirements. This is important because entering these industries is not simply a matter of installing another machine. The company has to qualify products, build customer confidence, demonstrate consistent quality, and then scale production. Management therefore appears to be building the capabilities before the entire revenue opportunity becomes visible. The company has already expanded its precision machining capacity to support higher forging capacity. It is also targeting critical areas such as defense components, the heaviest category of closed die forgings, and high-precision machining. Closed die forging means shaping metal inside a specially designed mold under very high pressure. The heavier and more complex the component, the more difficult the manufacturing process becomes. That is why the company's investment in a 25-ton hydraulic hammer is important. The equipment is designed to increase its ability to manufacture large and complex forged components and was under commissioning according to the company's investor presentation. But management's promise does not stop with capacity. There is also a technology promise. The company has invested in 7-axis and 11-axis machining systems. It is using automation and digital systems. It is developing Industry 4.0 capabilities. And it is prioritizing fully machine value-added components. Industry 4.0 is essentially the use of connected machines, data automation, and digital control to make manufacturing more efficient, traceable, and precise. The strategic intention is clear. Balu Forge wants to capture more value from every component rather than simply increasing the quantity of metal it processes. That is an important distinction for investors, because growth in physical volume does not automatically mean growth in economic value. A more sophisticated finished component can potentially generate greater value from the same manufacturing ecosystem. Then comes the defense ambition. The company has commercialized a dedicated empty shell production line with a capacity of approximately 360,000 shells annually. It has initiated additional capacity expansion through internal accruals. Internal accruals simply means money generated within the company rather than raised from external investors or lenders. Management has also signed a 5-year memorandum of understanding for large-caliber ammunition supply, and has secured its maiden aerospace order from a US customer. These developments reveal what management believes the company can become. But there's an important distinction that investors should never lose. A memorandum of understanding is not the same as guaranteed revenue. An order is not the same as completed delivery. A new factory is not the same as full utilization. And a new customer is not the same as a mature recurring relationship. The company itself makes this distinction in its investor material. Its future statements are explicitly described as forward-looking and subject to risks including government actions, political and economic developments, technological risks, and other factors that could cause actual results to differ materially from expectations. So management is not promising certainty. It is presenting a direction. And that direction can be reduced to one very simple equation. More capacity, more customers, more high-value products, more defense and aerospace, more international business, and ultimately more profitable growth. But management has to prove every link in that chain. The most interesting promise may actually be the change in revenue mix. The company says defense, aerospace, and railway businesses are becoming increasingly important, while its traditional businesses will continue to grow even as their relative contribution falls. If that happens, Balu Forge could gradually become less dependent on conventional automotive cycles. That would potentially make the business more diversified and could support a different valuation from the market. But diversification only creates value if the new businesses earn attractive returns. And that brings us back to the issue we explored earlier. Cash, capital, utilization, margins. The company can spend money building a larger manufacturing platform. But eventually that platform must produce enough earnings and cash to justify the investment. This is where management's promise becomes an investor's test. Investors should not ask whether management sounds confident. They should ask whether each new period provides evidence that the plan is working. Is revenue growing? Are margins holding? Are new sectors contributing more? Is capacity becoming productive? Are customer additions continuing? Is working capital under control? And is operating cash flow beginning to catch up with reported profit? If those signals move together, management's strategy becomes increasingly credible. If they move apart, the story becomes much harder to defend. And there's one final reason this matters. The market is already valuing Balu Forge as a company with significant future potential. So management does not merely have to deliver growth. It has to deliver enough growth and enough profitability to justify the expectations already embedded in the valuation. That takes us to the next part of the story. Because once we know what management wants to build, the next question becomes uncomfortable but unavoidable. How much of that future has the market already paid for? Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. A great company can still become a poor investment when the price assumes too much of the future. This is where the Balu Forge story becomes much more interesting because the company is no longer being valued like an ordinary forging business. The market is already assigning considerable value to what Balu Forge could become. At the latest reported price of around 639 rupees, the company had a market capitalization of roughly 7,750 crore rupees. Market capitalization simply means the total value the stock market is assigning to all the shares of the company. The reported price to earnings ratio was around 29 times. The price to earnings ratio compares the market price of a company with the profit earned per share. At first glance, that does not look extreme. The peer median shown in the company data is around 27 times earnings. So Balu Forge is not trading at a dramatic premium to the broader group. But that comparison hides something important. Balu Forge is growing much faster than most of those peers. Its sales have grown at roughly 50% annually over 3 years and 5 years. Profit has grown even faster, around 88% annually over 3 years and more than 100% over 5 years. That is why another ratio becomes particularly interesting. The PEG ratio. PEG means price earnings to growth. It attempts to compare how much investors are paying for each unit of expected earnings growth. Balu Forge has a reported PEG ratio of around 0.33. On the surface, that looks unusually attractive. But investors should be careful. PEG is only useful when the growth rate is sustainable. A company cannot compound profit at 100% forever. So the real question is not whether Balu Forge looks cheap against its historical growth. The real question is how much of that extraordinary growth can continue from here. And this is where valuation becomes a forward-looking exercise. Imagine the business grows strongly for several years. Defense becomes a much larger contributor. Aerospace qualifications translate into recurring programs. Railway business expands. Machining capacity rises. The new factories reach healthy utilization. Margins remain strong. And cash generation improves. In that scenario, today's valuation could prove reasonable even if the stock does not look traditionally cheap. That is the central idea. The investment case does not require Balu Forge to be cheap. It requires the future earnings to grow into the valuation. But there is another way to examine this. Price to book value. Book value represents the accounting value of the company's net assets after liabilities. Balu Forge has a book value of roughly 131 rupees per share. Against a market price around 639 rupees, the market is therefore valuing the company at several times its accounting net worth. That premium is understandable for a company earning strong returns on capital. But it also creates an expectation. The new assets being created cannot simply sit on the balance sheet. They have to generate returns. Return on capital employed is the profit generated from the capital tied up in the business. Balu Forge has historically produced healthy returns, but its latest reported ROAS has moderated to around 23%. That means the market is effectively saying, we believe these assets will become significantly more productive. If that happens, the valuation can remain supported. If returns continue falling as capital expands, the valuation becomes more difficult to justify. Then there is enterprise value to EBITDA. Enterprise value is the value of the operating business after considering debt and cash. EBITDA means earnings before interest, taxes, depreciation and amortization. It is commonly used to compare operating businesses because it looks at earnings before financing and certain accounting charges. For Balu Forge, this measure is particularly relevant because the company is in an investment phase. Depreciation is rising because the asset base is increasing. Debt has also increased from the previous year. So looking only at the P/E ratio can miss part of the capital intensity of the expansion. The more important question is whether EBITDA grows faster than the capital required to create it. That is where the valuation eventually gets decided. Then comes discounted cash flow. A discounted cash flow valuation estimates the future cash a business can generate and converts those future amounts into today's money. This method is particularly revealing for Balu Forge because the company's current cash generation is much weaker than its reported accounting profit. The company reported FY26 profit after tax of around 259 crore rupees, while operating cash flow was only around 32 crore rupees. That does not automatically invalidate the earnings. The company has been investing heavily and carrying significant working capital. But it means a conservative investor should not value the business purely on today's accounting profit. The future cash generation has to improve. If profits rise substantially and operating cash flow follows, the intrinsic value can rise meaningfully. If profits rise, but cash remains trapped in receivables and inventory, the economic value of those profits becomes less convincing. There is another valuation framework that is especially useful here: earnings power value. Earnings power value asks a simple question. What would the business be worth if its current sustainable earning ability continued without assuming extraordinary future growth? For Balu Forge, that produces a fascinating result. The company already has a profitable core business with strong margins and healthy returns. So there is genuine earnings power underneath the growth story. But a significant portion of the market valuation is clearly connected to what the company could earn from its expanded capacity and newer businesses. That means investors are paying not only for today's Balu Forge, they are paying for tomorrow's Balu Forge. Replacement value provides another perspective. Replacement value asks what it would cost a competitor to recreate the company's manufacturing infrastructure capabilities, customer relationships, and accumulated technical know-how. Balu Forge has spent years assembling forging and machining capabilities. It has acquired manufacturing facilities. It has developed advanced machining capabilities. It has invested in defense manufacturing. It has built specialized ammunition infrastructure. And it has established relationships with global OEM customers. OEM means original equipment manufacturer. These accumulated capabilities would not necessarily be cheap or quick for a new competitor to reproduce. That provides some underlying strategic value that simple book value does not fully capture. But once again, there is a warning. Replacement value is not the same as shareholder value. A factory is valuable only when it produces economically attractive products. A machine does not create value merely because it is expensive. It creates value when customers pay enough for the output to generate attractive returns. Historical valuation gives us another useful reference point. Balu Forge has experienced extraordinary earnings growth, and its stock has also produced exceptional long-term returns. But the most recent one-year stock price CAGR shown in the data is only around 1%. That tells us something subtle. The company can continue improving fundamentally without the share price necessarily rising at the same speed. The market can pause. Expectations can reset. Valuation can contract. Or earnings can catch up with the existing price. This is why reasonable valuation matters more than simply asking whether the stock is cheap. At roughly 29 times earnings, Balu Forge is not being priced as a distressed manufacturer. It is being priced as a growth company with substantial future potential. The valuation can work if earnings continue improving and if independent signals continue converging. Those signals include growing revenue, strong operating margins, increasing strategic sector exposure, a large order pipeline, expanding capacity, new customer additions, and eventually stronger cash conversion. But the reverse is equally important. If growth slows, if margins compress, if capacity utilization disappoints, if working capital remains excessive, if cash flow continues lagging profit, or if defense and aerospace expansion takes longer than expected, then the market may decide that it has paid too much for the future. And this is the psychological heart of the valuation. Investors are not merely buying the current earnings. They are buying the belief that the current earnings are the beginning of something much larger. That belief can create powerful momentum when results keep validating it. But it can also create powerful disappointment when reality falls short of expectations. So what must Balu Forge do to maintain its valuation? It has to convert capacity into revenue, revenue into profit, profit into cash, and new capabilities into recurring customer relationships. Most importantly, it has to demonstrate that the return on the enormous capital being deployed remains attractive. If it succeeds, today's valuation can gradually become more reasonable because the denominator in the valuation equation keeps getting larger. The company grows into its price. That is the real investment thesis. Not that Balu Forge is cheap, but that improving earnings, expanding strategic businesses, stronger utilization, and eventually stronger cash flow could justify the price investors are paying today. And now the story reaches a fascinating intersection. Because valuation tells us what the market expects. Fundamentals tell us what the business is delivering. But there is one more force that decides how quickly expectations can change. The market itself. And the market leaves clues long before everyone agrees on the story. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis. The next chapter is where we follow those clues. Market psychology. When the chart starts agreeing with the business. Is the market confirming the story? Marketing punchline. A business can improve for years without the stock market noticing, but when price behavior, volume, and business performance begin pointing in the same direction, the story can enter a very different phase. With Balu Forge, the technical picture becomes interesting precisely because it is arriving alongside a changing fundamental story. The stock has already experienced a substantial long-term re-rating. That means the market has not only discovered the company, it has already rewarded part of its transformation. But the important question now is different. Is the market still willing to support the next stage of the story? To understand that, we first need to understand what technical readiness actually means. Technical analysis is simply the study of price and trading activity to understand how investors are behaving around a stock. It does not tell us what a company is worth. It tells us what the market is doing with the information it currently has. And in Balu Forge, that distinction is critical. The long-term price structure shows a company that has moved from a relatively low valuation base into a much higher valuation zone. The stock has produced exceptional long-term returns. Its 3-year price compound annual growth rate has been around 52%. That means the market has already recognized a significant part of the earnings transformation. But strong historical performance alone is not a buy signal. In fact, it creates a new problem. After major re-rating, the market begins demanding evidence that the earnings can justify the higher valuation. That is where the recent structure becomes important. The stock has shown the characteristics of a powerful uptrend. An uptrend simply means that the market is consistently willing to accept higher prices over time. But healthy uptrends are not straight lines. They move forward, pause, consolidate, and then attempt to move again. A consolidation is simply a period when buyers and sellers temporarily reach a balance after a strong move. This period is extremely important because it tells us whether earlier buyers are willing to hold their positions and whether new buyers are prepared to enter at higher valuations. Balu Forge has shown such periods of digestion after its earlier advances. The recent movement has again brought the stock close to an important test of market conviction. And this is where volume becomes extremely useful. Volume is simply the number of shares changing hands during a period. When price rises with strong volume, it tells us that the move is attracting substantially greater participation. But volume should never be interpreted in isolation. High volume can represent aggressive buying. It can also represent aggressive selling. The context matters. When expanding volume accompanies a stock moving out of a prolonged consolidation, while the underlying earnings story is improving, the combination becomes much more interesting. It suggests that the market may be repricing the probability of future growth. There is another useful observation. Balu Forge has shown strong relative strength compared with its longer-term historical behavior. Relative strength simply means the stock is performing better than the comparison group or broader market. For a growth company, this matters because institutional investors often concentrate capital in companies where earnings momentum and price momentum reinforce each other. Institutional investors are large professional investors such as mutual funds, insurance companies, pension funds, and investment firms. They can influence price significantly because they deploy much larger amounts of capital than individual investors. The shareholder data also gives us an interesting background. Foreign institutional ownership has declined from earlier levels, while public ownership has increased. Promoter ownership has also gradually declined. That means the recent price behavior cannot simply be explained by a dramatic increase in foreign institutional ownership. The market is still evaluating the company through a broader mix of participants. And that makes the technical structure more interesting rather than less. Because the stock needs to demonstrate that demand can absorb the available supply even as expectations rise. This is where support and resistance become useful concepts. Support is an area where buyers have historically shown enough interest to prevent prices from falling easily. Resistance is an area where selling pressure has previously become strong enough to prevent prices from rising easily. The important point is not the exact price level. The important point is what happens when the stock reaches an area where many previous investors have made decisions. If the stock approaches an old supply zone and sellers overwhelm buyers, the market is saying expectations may have moved too far. If the stock absorbs that selling and continues to establish higher levels of demand, the market is saying something very different. It is saying that investors are becoming comfortable with a higher valuation. And that is where technical readiness becomes valuable. Not because the chart predicts the future, but because it allows us to observe whether investors are actually accepting the future that the fundamental story is describing. There is also an important warning. Momentum can become excessive. Momentum means the speed and persistence with which buying or selling pushes a stock in one direction. When momentum becomes extremely strong, the stock can move far ahead of its underlying earnings. That creates a dangerous situation. The business can continue performing well, yet the stock can still correct because investors had already priced in too much success. This is especially relevant for Balu Forge because valuation is no longer based purely on today's earnings. The market is paying for future growth. That makes technical behavior more sensitive to changes in expectations. A disappointing result can therefore have a larger effect than it would on a low expectation stock. But when technical strength appears together with improving fundamentals, the interpretation becomes much stronger. Revenue growth is healthy. Operating margins have recovered from the previous period. strategic sectors are becoming more important. The order book contains a much larger proportion of defense, aerospace, and railway business than current revenue. Manufacturing capacity is expanding, and the market is showing sustained interest in the stock. These are separate pieces of information. That is what makes their convergence important. The chart cannot tell us whether Balu Forge will successfully execute its aerospace strategy. The order book cannot tell us exactly when every order will become revenue. The financial statements cannot tell us whether investors will continue paying the same valuation multiple. But when these independent signals begin pointing toward the same conclusion, the investment case becomes more compelling. That conclusion is not that the stock must rise. It is that the market appears willing to test the possibility that Balu Forge is entering a larger earnings cycle. And that brings us to an important distinction between technical strength and technical readiness. Technical strength describes what has already happened. Technical readiness asks whether the stock is building the conditions required for another sustained move. That requires demand to remain strong, selling pressure to be absorbed, volume to support important advances, and the underlying business to continue producing evidence. If the business disappoints, the technical structure can change very quickly. If the business continues to surprise positively, the market may gradually accept a higher valuation. That is why the technical picture should never be treated as a separate chapter from the business. It is the market's reaction to the business story. And perhaps the most fascinating part is that markets do not wait for complete certainty. They move when enough investors begin believing that the future could be different. That belief can become powerful, but it can also become dangerous. Because once a large number of investors begin believing the same story, the stock price can start reflecting that belief faster than the company can deliver the underlying results. And that brings us to the next chapter, the psychology behind the stock. Because ultimately prices are not moved by financial statements alone. They are moved by what investors believe those financial statements mean about the future. Story behind stocks. Understand before you invest. Subscribe for deep stock stories and analysis.